Ready to grow your money without the taxman taking a huge bite? That's the question every smart investor asks. We've all heard the term tax-efficient investing, but what does it really mean, and how can you use it to your advantage? It's not about avoiding taxes illegally, it's about making smart decisions within the legal framework to maximize your after-tax returns. The tax-advantaged account's advantage. The simplest and most powerful tool in your tax efficiency arsenal is the tax-advantaged account. Think of these as special containers for your investments that shield them from immediate taxes. The most common examples are retirement accounts, like 401(k)s and IRAs. Traditional versions give you a tax deduction today, lowering your current taxable income. You pay the taxes later when you withdraw in retirement. Roth versions are the opposite. You invest money you've already paid taxes on, and then all the growth and withdrawals in retirement are completely tax-free. Beyond retirement, don't forget health savings accounts, HSAs. These are often called the triple tax advantage because contributions are tax-deductible. The money grows tax-free. Withdrawals for qualified medical expenses are tax-free. It's a powerhouse. Strategic investing in taxable accounts. Now, let's talk about the money you can't fit into those special accounts, your taxable brokerage account. Here, the key is to understand and utilize capital gains rules. When you sell an investment for a profit, that profit is a capital gain. If you hold the asset for less than 1 year, it's a short-term capital gain, and it's taxed at your ordinary income tax rate, which can be quite high. But if you hold it for more than 1 year, it becomes a long-term capital gain, which is taxed at a significantly lower rate for most people. The message here is clear: patience is a tax strategy. Aim for a buy-and-hold approach to lock in those favorable long-term rates. Another powerful technique is tax loss harvesting. If you have investments that have done well and you need to sell them, you can offset some of those taxable gains by selling a different investment that's currently at a loss. This reduces your overall tax bill for the year. It's a great way to turn a market dip into a tax benefit. Product selection for tax efficiency. Finally, let's look at what you're buying. In your taxable brokerage account, lean towards low-turnover mutual funds and exchange-traded funds, ETFs. Funds that trade a lot internally generate capital gains that get passed on to you every year, increasing your tax bill. Low-turnover funds minimize these distributions. Also, consider municipal bonds, or munis. The interest you earn from these bonds is often exempt from federal income tax, and sometimes state and local taxes, too. In short, tax-efficient investing isn't complicated. It boils down to 3 core actions. Prioritize your tax-advantaged accounts. Hold your investments for the long term. Choose tax-efficient products like low-turnover ETFs in your taxable accounts. With that said, thanks for watching, and until next time.